The home equity lending market is gaining momentum again, and this time institutional investors are leading the charge. A new report from the Mortgage Bankers Association, MBA, projects that home equity loan balances will climb by 7% this year, while home equity lines of credit, HELOCs, are set to grow nearly 10% by the end of 2025. Wall Street is taking notice. Investment firms issued about $18 billion in bonds backed by home equity loans last year, tripled the volume recorded in 2023. For investors searching for stronger returns in a tightening credit environment, these numbers mark a shift. Home equity loans and HELOCs carry more risk than traditional first-line mortgages, but deliver higher yields. What's changing now is how data analytics, automation, and artificial intelligence are reshaping how those risks are measured, mitigated, and managed. The appeal is obvious: higher yields, lower entry costs, and a surge in borrower demand, said one structured finance analyst. But the difference between profit and loss comes down to the quality of data and the precision of execution. Home equity portfolios have always been complex. These second lien loans offer strong interest margins, but expose investors to greater loss potential because repayment comes only after the first mortgage holder in a foreclosure scenario. Rising delinquency and foreclosure data from early 2025 underscore that risk. A report from ATTOM showed that foreclosure starts rose 14% in the first quarter, while the MBA reported an increase in overall delinquencies. Even small increases in borrower distress can quickly erode returns. To stay ahead, investors are turning to automation and data science. Machine learning and AI models now analyze millions of loan files in days instead of weeks, identifying irregularities, missing data, and borrower risk indicators long before deals close. Blockchain-based ledgers are also being adopted to store verified records of ownership, valuations, and loan performance, eliminating many of the inefficiencies that once plagued portfolio transfers. Technology isn't just speeding up due diligence, noted a fintech executive. It's redefining what trust means in financial data. Once loan information is digitized and verified through AI and blockchain, transparency becomes a competitive edge. Artificial intelligence is now driving much of the operational improvement across home equity portfolios. Algorithms can cross-check appraisals, detect inaccurate interest calculations, and flag servicing errors that might otherwise slip through manual reviews. Servicers are also using AI to manage collections, monitor bankruptcy cases, and detect signs of borrower distress early, allowing interventions before loans slide into default. These efficiencies have cut operational costs, improved accuracy, and reduced time to decision, helping stabilize returns in a volatile sector. But even as automation reshapes the industry, human expertise remains indispensable. Portfolio managers still provide the intuition and judgment that machines can't replicate, assessing local housing trends, borrower intent, and market dynamics. Technology gives us the visibility, said one private credit portfolio manager. Experience tells us what actually matters. This convergence of AI, data analytics, and human insight is transforming how home equity investments are valued and managed. What was once seen as a risky corner of the market is now emerging as a mainstream, yield-driven asset class. Investors with the infrastructure to harness clean data and the discipline to manage it effectively are reaping the benefits, turning volatility into opportunity. As second lien lending becomes more central to modern portfolio strategies, automation is rewriting the rules of risk management and return generation. With rising home values and robust consumer demand, the next phase of home equity investing won't just be about higher yields, it will be about smarter, faster, and more transparent decision-making. As one industry veteran put it, this is the future of mortgage capital markets. The investors who master automation and data aren't just chasing returns, they're building the foundation for a new era in real estate finance.